Hi, everyone. This is Jeff Praissman of the Interactive Brokers Podcast. And it's my pleasure to welcome to the podcast Matt Cashman. Today, we're going to be stepping back to look at option markets in 2025. So, if you've been trading or hedging or even just watching the markets this year, it's probably felt a lot happened really quickly. So, the question I'm going to be asking is what actually changed and what matters going forward? And as I said, we have our special guest, Matt Cashman, the principal of investor education at Option Clearing Corporation and a longtime options market practitioners, and also a longtime friend of the show. Matt, welcome back.
I am a longtime friend of the show. Jeff, it's great to be here. Thanks for having me.
I love having you in the podcast, and especially as we wrap up this year, this seemed like a really appropriate topic to tackle. And I can think of no one else that we'd rather have tackle it than you. Let's start at the top, Matt. When people look back at 2025, what should they understand about the scale of the options market?
That's a really great place to start because that's where some of the major changes have happened. I think the most important starting point for this year is that 2025 wasn't really a pause year. It wasn't a digestion year. Industry wide options activity continued to grow meaningfully on top of what we had already as record levels in 2024. If you look at OCC cleared volume through late 2025, we're recording this kind of midway through December. So the full number is not going to be known, but total US listed option volume was running well ahead of 2024, which, like I said, already was a record year. We're talking about tens of billions of contracts. Average daily volumes are looking north of 60 million contracts across equities, ETFs, and index options. And if you multiply that 60 million average number times 252 trading days, which is how many trading days are in a year, you get north of 15 billion contracts, which is probably what we're going to end up clearing for the whole year. And that growth wasn't just isolated to one kind of product or one area. It was kind of across the entire venue. Equity options, ETF options, and index options all contributed to that. And that really matters because it tells us that this isn't just a speculative froth in one part of the market. Options are now really like a what people consider a core risk transfer and kind of risk expression tool across the entire investment ecosystem. And that's a really good thing, I think.
So, Matt, from what I'm kind of gathering from this, like this wasn't just this big uptick in volume. It wasn't just like retail enthusiasm or even like one hot product, like everyone's just diving into something. Like this was really like diversified and spread out.
Yeah. Yeah. I think that's 100% true. Retail participation remains an important part of this market, but what you're getting on top of all of that is institutions and advisors and structured product desks, volatility funds, and systematic strategies. Sorry, they're all using options more actively than they have previously, even 2 or 3 years ago. And the options market in 2025 looks a lot less like a niche derivatives market, like you said, and more like market infrastructure that's happening kind of across the entire spectrum.
And something, and not just in the options market, but something always amazes me, like how something new or novel, if it's working, becomes normal, right? Like a long time ago, like whatever 25 years ago, no one had cell phones, and now like no one doesn't have them. But like I'm kind of shifting into the option conversation, short dated options, right? Like they were something new not too long ago, but now they just seem like they're part of the landscape. Like what especially this year, like what changed?
Absolutely. Yeah. I think this is a big story, not just the numbers and the rotation that we saw in 24 and 23 into these shorter dated options. I've been talking about zero DT options for almost going on 3 years now. And 2025 is really the year that these shorter dated options fully crossed the line from like, oh, that's interesting. And people thinking about it in an interesting way to like what you just said, which is like it's becoming kind of institutionalized. It's becoming this part of the baseline levels of the marketplace that we've seen in 0 day options and more broadly, just kind of like short dated contracts have really become a persistent and a predictable share of index option activity across the industry. like a majority of the index options volume on many days is expiring within the next 24 hours. And that's a huge, like it's a structural shift. I mean, it's important because they're being used for intraday hedging. People who want to trade event driven positions, volatility expression without the overnight exposure, which is a big part of kind of how those options work. And then systemic, or systematic, sorry, I keep using those two words interchangeably, systematic income strategies, which is a lot of kind of where that flow is coming from. It's not just directional trading and it's not just retail, I mean, it's across the entire spectrum. So that's a big change in 2025.
Yeah, it's huge, and it's funny too because, kind of aging myself here, but yeah, I remember when weeklies came into play. Like everyone's like,
Yeah.
"Oh my God, we're gonna have expiration every week," and now it's daily. So, obviously, we've in the past we've talked about the Greeks and theta obviously, and gamma and delta, the kind of the three big ones. But, how do with this less than 24-hour expiration cycle, how does it change, how the markets behave intraday when there's such little time till they're either, you know, either being assigned or exercised or going away worthless with, such little leeway?
Yeah, that's a good question, and it gets at the nuance of how I think we should think about this going forward. It doesn't really change necessarily, and I talk about this all the time. It doesn't necessarily, I think, change where the market is necessarily going, right? It doesn't like. I think people try to glean a certain amount of idea about the direction of the market from those positions. But I think what it really talks about is kind of where the sensitivity lives. It's far more how I view it is you shouldn't necessarily look at the short dated option portfolio of the broader market and think about like the fact that we're going to this place as far as price is concerned. But what it says to me more is if we do get to that level because of the fact that there are larger option positions there, your sensitivity to what's happening and like your ears should kind of perk up a little bit more because there's just more potentially dynamic hedging that has to happen and it has to happen quickly, right? We're talking about options that expire very, very soon. And because of their risk profile, it begets a certain amount of dynamic hedging that is a part of that landscape and happens quickly when the market does move there. So it's not necessarily something that is a systemic risk, right? When we first started thinking about this, just like you said, we were talking about like, oh, there's going to be a weekly expiration every week. And then it became, right, a Monday, Wednesday, Friday. And then it became a Monday, Tuesday, Wednesday, Thursday, Friday thing. And people were talking about systemic risk that it might be a part of that landscape. And it hasn't really played out that way. But what it has become is a big part of how the market works. And so I think it's really incumbent upon us to think about that and how risk is handled and think about that and how we look at the market on a day-to-day basis.
Yeah, and that's a good point. That's something I think people don't think about enough is like, how does clearing work with this and margining and risk and like, so everyone's just thinking of like the sexy part, the option part, but they're not thinking of the under the hood. So,
Yeah.
how has the industry responded to this, really a great more of a not just demand for these products, but a demand on them to be able to make sure that these are, safely handled, I guess would be the right word. And
Yeah.
you know, and everything's above board.
Yeah. This year, I think 2025 was a year of kind of like, well, what I would call infrastructure response. It's not like reactionary panic. It's not people, freaking out about these numbers being that big. It's more clearing and risk frameworks that are evolving to better reflect things like intraday risk, which OCC changed, kind of how people are margined intraday. That happened relatively recently. They're modeling jump risk in a different way and really talking about the nonlinear behavior of these shorter dated options. Like I said, at the OCC level, enhancements to short dated option margin modeling were implemented specifically to capture risks that don't show up in an overnight traditional stress test, right? That's an overnight that we've been using forever. But in reaction to the fact that so much of this volume has rotated into these options that are expiring, that isn't captured by the overnight risk modeling. The OCC changed how they actually margin shorter dated options, and that's part of that process going forward. And it's a proactive way to address things like this, to make sure that these systemic risks that everyone talked about when we first started thinking about these contracts don't appear as these positioning trades get larger and larger.
And I do like the a proactive approach is always good, not waiting
Yeah.
for things to break. But is this something that retail traders should even care about, or is it sort of nothing for
Yeah.
them to worry
I
about?
mean, yeah. You if you're a retail trader, you should care about this, because
Mhm.
guess what? Your broker, right, or your clearing member firm who is being margined differently at the OCC level, especially if that requires more margin, generally speaking, is not in a position where they feel like taking on all of that margin requirement themselves. This is a model that gets kind of like trickled down, right? And so margin models and clearing risk frameworks ultimately shape capital requirements at brokerage houses, which then essentially change the capital requirements for the customers of those brokerage houses, which are ultimately the retail clients. It affects product availability, like what is there, what is available to trade, what are the things that we can trade based on the margin that we carry. And then it also sometimes affects how quickly firms can respond during volatile markets. When the risk models improve, the market becomes just more resilient, it becomes more robust. It doesn't necessarily mean that it's less accessible. It means that it's built on a stronger framework underneath it. And I think that's an important part of this also.
Yeah, no, absolutely. And as we're winding 2025 down, it is nice to kind of sit here and kind of reflect on the year. And you know, what was some of the the kind of the theme of this year? There's as like, probably every year there's always like new products, right? Like there's always something coming out. What are a few that stood out to you this in 2025?
Yeah. So for 2025, I think there were really two big ideas that dominated in that regard. The first one's concentration. Like, I think we saw index products that were designed to isolate really specific thematic ideas, particularly like mega cap tech
Hmm.
exposure. I think that's something that people have been talking about for a while. And 2025 was the year where I think a lot of that came to fruition, and a lot of these products give investors index style efficiency with more targeted risk, right? Like a more granular way to express that risk. And then the second one, I think it kind of goes without saying, but it's the options embedded inside wrappers. You see this everywhere in the ETF space, right? Defined outcome ETFs, buffered strategies, leveraged and inverse structures globally across like the entire options ecosystem all increasingly rely on listed options as the engine of how those products create those defined outcomes, right? Anytime I always say this when I talk about defined outcomes and ETF specifically, anytime you're looking at something, especially an ETF that says defined outcome in the title or in the name, they're using options to create those defined outcomes, because there's no other way really that they can do it. And so the through line here, I think, is this: options aren't just something that you trade, they're something that you kind of like build with. And the broader ecosystem is really starting to kind of catch on to that idea and be able to use the leverage that's inherent within those options to build these strategies and then push them out to the end user and make those things available across the board.
And another thing I noticed, like, we also really starting to see an expansion in trading hours. For example, Interactive
Yes.
Brokers offers about 10,000 U.S. stocks and ETFs, almost 24 hours a day through extended hours. I think it's like 23 hours and 50 minutes between exchange hours and extended hours and our own overnight trading.
Yeah.
Um, what do you think the future of the industry with that is?
Well, I think there's only really one way to go as far as that's concerned, right? Which is probably more access more of the time. I think it's a subtle, but it's an important shift because of all of the different things that we've already talked about as far as that's concerned. Risk wise, extended trading hours for index options continue to gain traction, more traction than they already had in 2025. More participants outside the US time zones are accessing the US risk using listed options. I'm sure you guys see that directly at IBKR, right? I mean, you're a global firm that has a lot of customers that are outside the United States. But this doesn't mean that markets or the traditional markets are suddenly 24/7 like crypto. This is kind of going to be an incremental shift, just like you suggested. But it does mean that the idea, and I think this is another thing that we have to start to talk about as an industry, is what is a single trading day actually? What does that mean, right? When you're in an environment where there's no like necessarily closing bell like there used to be, right? Like we're dating ourselves again. We were talking about like when they rolled out the weekly expirations for the first time and everyone freaked out. Well, now we're getting to a point where we have to rethink the idea of the closing bell, and that there might, that might be something that might kind of like go away. This has implications for things like liquidity provisions, hedging behavior. Think about all of the algorithms that are designed to hedge on the close, right? Or through VWAP or things like that, and operational readiness across the brokerage and the clearing world. It needs to be something that is built into the conversation at many different levels as we're moving in that direction.
So Matt, just to clarify, you don't think the exchanges are going back to being closed on Wednesdays, right? Just to, to really date ourselves before we were even there, right?
No, I don't think that's happening, Jeff. No, we're headed the opposite direction, brother. We're only going one way. This is a train that only goes one way. So, yeah, I would agree.
So looking ahead to next year,
Yeah.
what do you think people should be watching, for in 2026?
Yeah, so I think there's three main things there. The first one is keep an eye on the shorter dated options and how they continue to be integrated into like institutional workflows. That's a big part of this. And then as a kind of adjunct to that, the NASDAQ applied for single name 0-day options in a very specified way. That's a big part of that as well. That's going to be a continuing development in that story. So keep an eye on that. And then second, I think the risk modeling and the margin evolution that goes along with that, the more accurately that we are able to price and manage intraday risk, not only from the OCC and the clearing side of things, but also operationally from the brokerage side of things at the individual level, the healthier this market is going to become. And then third, I think always from my seat is the education aspect of it. Options are powerful tools. They are, they're leveraged instruments, but only if people really understand the trade-offs that are embedded in them, what they can do and what they can't do. So much of my time is spent trying to telegraph those concepts to people. And I know it's like, I probably sound like a broken record most of the time, but it's a really important part of this because they are leveraged instruments, and it's a large part of how this market is going to continue to grow is by making sure that people understand how those contracts work. So 2025 shows that options aren't really a sideshow anymore. They're central to how this market functions, and I think education is a big part of that as well.
Matt, this has been great as always. And for our listeners, to get more from Matt, you can go to www.theocc.com and optionseducation.org as well. Or as well as check out our website. Just click on the education tab at ibkr.com, and you can check out past webinars, past podcasts, and upcoming events from Matt Cashman and all our wonderful content providers. Matt, thanks again. Happy holidays. Have a happy new year.
Absolutely. Thanks for having me, Jeff. It was a pleasure as always.
Excellent.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, Those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest. Complex or leveraged exchange-traded products are complicated instruments that should only be used by sophisticated investors who fully understand the terms, investment strategy, and risks associated with the products.